Hi, I'm Dan Danford. We're doing a series of podcasts for DadsDivorce.com where we take questions from viewers of the site and I give the best answer I can come up with on that particular topic. This week's question is pretty simple. I'm trying to add up some costs on how much buying a new home will cost me each month. What is a good way to estimate the cost of house insurance? Really good question as you prepare kind of to get involved in buying a home and all the costs and utilities and things that go along with it. And I really have two answers to the question, and both of them are pretty simple, to be honest. The first is to basically contact your insurance agent. Most companies that offer car insurance, for instance, also offer house insurance. So probably what you ought to do is whoever's covering your car right now, you just give them a call, or if it happens to be one of the internet places, just hook up on the internet and contact them and give them kind of a price range that you're looking at. If you're talking to them, you might tell them what neighborhoods you're in. And they'll be able to give you a pretty close cost. Now, this isn't going to be a quote that they're going to lock in stone or anything because you haven't bought anything. But they'll be able to tell you whether that kind of coverage is going to cost you, $600 a year or $1,000 a year. And that's probably good enough for making these kinds of projections. Now, when you actually get ready to buy the insurance, it makes sense maybe to contact a couple of different providers and get an actual quote. It may end up, because of competition, being a little bit less than what you originally got at the first place, but it never hurts to overestimate rather than underestimate. So that's the first step, is just contact whoever you're buying insurance from now and just ask them to give you a price quote, at least an estimation. That'd be good enough to work with. The second one's equally as simple, and if you're working with a mortgage banker right now, lots of times if you're getting ready to go buy a house, it makes sense to make a connection with a mortgage banker, and that mortgage banker can get you pre-approval or whatever. It just gives you more negotiating strength when you get ready to make an offer on a home. But if you're already working with somebody like that, ask them to give you an estimate. And again, they do this all the time, and they work with specific neighborhoods and they work with specific kinds of houses. And it may not be locked in stone, but they'll be able to give you a pretty good estimate of what coverage might cost. Okay? So that's your second choice, is whoever you're going to work with on the mortgage, ask them to make some projections or some estimates for you that you can use. Now, taking it a step further, there are a lot of different options when it comes to insurance. And you can get different quotes from different companies, and they may not even seem like they're in the same ballpark. But the reason why is because there's so many different types of coverage, so many different things you can do in terms of coverage. So just a couple of kind of guidelines that may help you. One is you want to make sure that whatever deductibles you have on your policy make sense for you. Now, the reason I say that is because your premium amount will be tied specifically to how high your deductible is. In other words, if you have a deductible that's very high, say $2,500 or $5,000, the coverage on that's going to be a lot less than it is if you have a deductible of $1,000 or $500, simply because you're going to have fewer claims. Okay? And the insurance company understands that. They understand that if you have a $5,000 deductible on your policy, you're probably only going to file a claim if there is a catastrophe involved. Because other than that, you're going to pay for it out of your pocket. If you have a $500 deductible, then you're likely to file more claims, and so the premiums will be higher. You don't want to get insurance that doesn't give you coverage you need. In other words, if you're going to have trouble having money in the bank to take care of a $1,000 damage claim, then you better have the $500 deductible. But if you've got the financial means to take care of those claims when they come in, those damages out of your own pocket, you might as well have the higher deductible and save the premium that you'd have to make. So that's one thing, is to set up your deductibles the way you want. Another thing is to probably get something called inflation protection on the insurance coverage. In other words, when you buy your house today, it may cost $100,000. But even at 3% a year, in several years' time, that house is worth a lot more. If the house burns down, you want to make sure that you get enough money from the claim to actually take care of getting a new house or replacing the one you've got. So inflation coverage makes sense. It'll make the policy cost a little more, but it's worth it, because otherwise you could be left with a damage claim for a $100,000 house and find out 5 years from now or 7 years from now it's going to cost you $150,000 to get a similar house. The last one, this one sounds sort of like the inflation coverage, but it's called replacement cost coverage. The simple way to look at it is some things about your house lose value over time. Like if you put a new roof on your house, it might cost $15,000 to put a new roof on your house. Okay, if a major hailstorm comes along 5 years from now and ruins that roof and you have to put a new roof on, okay, what the typical coverage is going to do is they're going to come in and they're going to say, well, yeah, it did cost $15,000, but you've used 5 years of that, so we're only going to pay you $10,000 for that roof. Now, your problem as a homeowner is, by now it may cost $20,000 to replace that roof instead of $15,000. So without replacement coverage, you're only going to get $10,000 and you're going to have $10,000 on your own. The simple way to solve that problem is to get what's called replacement coverage on your house insurance. That basically will take care of putting a new roof on your house when the roof is damaged by hail. The same thing with other things that are covered in the policy. There's certain kinds of things with appliances and things like that that might be covered under a house policy. Well, if a 5-year-old refrigerator dies, with replacement coverage, you'll be able to go out and get a new one. So again, that'll make your premiums a little higher, but it's worth getting. So I guess overall on this topic, it's pretty easy to get estimates, either from a current insurance agent or possibly from the people you're working with on the mortgage. Check the coverage, and when you compare one insurance company to another, make sure that you're comparing apples to apples, the same kind of coverage in both places. And then the last fail-safe that I'll add is that most mortgage companies today require your insurance coverage as a protection for them. Okay, so most of them collect that insurance as part of your monthly house payment. They put it in escrow, and then they pay the insurance for you once a year or twice a year, whenever the premiums come due. Okay, they aren't going to let you make a bad mistake here. Okay, they're going to check out your coverage and make sure that the coverage is proper and good, and that it takes care of your house should something happen, because that's a way of protecting their mortgage as well. So seriously, this is not a complicated subject. It's pretty easy to get good estimates. They will depend on what neighborhoods you're in and what cities you're in, but you should be able to gather helpful information to help you as you make plans to buy a home. That's it for this week's podcast. Thanks for joining us. We'll see you again next week.